welcome to another one of your Southern California real estate podcast. My name is Albert Ramos and I am your host. Today we are going to be talking about home budgeting and what are some of the things that you should keep in consideration whenever you are budgeting. So let's get started. The first thing that we have to take in consideration is, do you have to save up for your down payment? Now, this is a big step because for some people, it's going to depend on the type of loan that you get. I specialize in VA home loans, and if you have a VA home loan, you have to save 0% for your down payment because the VA is backing you up with 25% in the case that you default on the loan. However, that is not always the case. With the conventional home loan, if you don't want to pay something that's called PMI, which is private mortgage insurance, you have to put down a down payment of 20%. And let me break down why is it that happens. If we compare the VA home loan with the conventional home loan, the VA is backing your loan with 25%. So if you default, they will pay 25% of however much your loan is. The conventional loan doesn't have that. So what guarantee does the bank have that they are going to get paid? And that is the reason why they have you pay 20% down. And if you don't, you pay that PMI, which that PMI or that private mortgage insurance is made to protect the banking institutions, not to protect you. Now, if you are using the FHA loan, the FHA loan still has a down payment, but it's 3.5% of the total purchase price of the home. Now, I want to break this down to the most common denominator. Most Americans, the average American, is actually able to afford their first home by the age of 33. And the reason for it is because let's look at this from a common sense perspective. You go from college, assuming everything goes perfect, right? Let's say you go to college at the age of 18. You graduate by the age of 22, 23 years old. You get yourself a starting position at whatever X company, and you start building yourself up through those companies. By the time that you're 25, 26, 27 is when you start really having some money that you can start saving up towards your deposit. And by the age of 33 is when you saved enough money to utilize either the FHA or the conventional loan, utilizing some of that PMI. The second thing that you want to budget for is your closing cost. Just because, for example, if you are utilizing the VA home loan and you are putting 0% down, that does not mean zero money towards a transaction. Your closing costs are going to be anywhere from 2 to 2.5% of the total transaction. So keep in mind that your closing cost is something that's going to have to get paid throughout the transaction. Number 3, and it's one of the things that has to get paid up front, not at the end of the close of escrow. You have to pay for a home inspection. Home inspection is one of the real estate contingencies, which I have a whole different videos on real estate contingencies right here, and you guys can go and check that one out too. Home inspection prices vary on the size and square footage of the home. It also depends if you pick, for example, a sewer scope, or if you pick any other, like a pool and spa, any of the other services that home inspector might require. But I've seen home inspections to be as low as $150 and as much as $500 and up. So keep in mind that that's a price that has to get paid up front, usually within the first 7 to 14 days of you beginning your escrow process. Another fee that has to get paid up front is your appraisal fee. Here in California, appraisal fees are $700, and that's a fee that has to get paid up front before the close of escrow, and that comes out of your pocket, not from your deposit. So keep in mind that appraisal fees for the VA is a requirement. If you're utilizing the FHA loan, or if you're utilizing the conventional loan, those appraisals can be waived. However, I don't recommend that the appraisal or any type of contingency for that matter be waived for any circumstances, because those contingencies and those appraisal fees are there to protect you. Now, why is it that you would want to waive your appraisal fee? The reason why you would want to waive your appraisal fee is to make yourself more competitive. Basically, what you're telling the seller is, listen, it does not matter how much money this home's appraised, I'm still going to buy it. Now, what are some circumstances that you will want to do that? Well, if you're utilizing an FHA loan and a conventional loan, because remember, if you're utilizing an FHA loan, you're putting a minimum of 3.5%. If you're utilizing a conventional loan, you're putting at least, 10 to 20% of the down payment. Now, that means that if you buy a home for $500,000, your loan is only going to be around $420,000, $430,000. So you don't really care if the home appraises at $500,000 because your loan is going to be for way less than that. However, if you're utilizing the VA home loan, just understand that you cannot, and I recommend that you do not waive that contingency, because the VA will only give you the amount of money that the house appraises at. If you guys have any questions, feel free to reach out to me at the information below. Throughout your closing costs, there are going to be some things that are going to be bundled together, and they're going to be included within your closing costs. Your application fees, your credit report fees, your loan origination fees. Also, you have to ensure that you put your property taxes and that you have your home insurance and home warranties in there. That actually gets put into the real estate contract, but those are things that are associated that make up the 2% that I was talking about earlier within your closing costs. Now, what is one of the biggest things that people always oversee whenever they are budgeting for a home? Remember, you're living somewhere right now, and you are going to have to incur in moving expenses to move from one location to another. If you're in the military, obviously try to take advantage of your PCS or your permanent change of station. That way the government pays for your move from one home to the other. However, if you are a civilian, you are on the hook in order for you to move from one place to another. There is a great app that I'm going to plug in here. It's called GoShare. Download the app, and that is an application that basically hires people. It's like an Uber, but for moving trucks. And you are able to hire them, and you are able to pay them directly through the app based on how big, on how small your project is. Highly encouraged to download the GoShare app. Now, the next thing that we want to take into consideration is also repairs and renovations, right? Because a lot of people always tell me, oh, well, I want to put down, I don't know, the 20%, or I want to put down the 25%. I want to put down however much percent that I want towards the home, so that way my mortgage payment drops significantly. And while that is not a bad idea, you also have to take into consideration that what would you rather have, a comfortable mortgage payment, or would you rather develop some sweat equity inside of that property so that way you raise the value of your home? Keep in mind that most first-time homeowners, on average, they stay in their first home anywhere from 5 to 7 years. So my recommendation to you, start planning out some renovations and some repairs that are going to raise the equity of your home. And I got some really good things in my Instagram that will help you with some of those renovations and repairs that will gain you the most money for your equity. Now, this next one is one of my top favorite ones, because this is what I think separates me as a real estate agent here in California. A lot of people oversee the budgeting for their furniture. Guys, I do not want you to be house poor. Yes, I want to get you into the house of your dreams. But as a first-time homeowner, guys, you are not understanding what becoming a homeowner fully means, and you're probably not going to understand it until you start seeing some equity inside of your home. Keep in mind that you have to budget for your furniture. You don't want to just simply have a home, a nice ass home in a very nice community, and not be able to put furniture in, or furthermore, not being able to enjoy the things that you currently enjoy doing already. Like, for example, going out to eat with your wife, or going to the movie theater with your kids, or the things that you currently enjoy doing. So ensure that you set yourself into the budget of furniture, moving expenses, and your current lifestyle. Okay, so we are down to the last two. And I think that this one specifically that I'm going to cover now, I think this is very common sense, but I got to mention it anyways, just in case, okay? You want to ensure that whenever you have your budget, you do not only include your PITI, which is principal, interest, taxes, and insurance. You want to ensure that you also include your utilities, right? And I have a whole different playlist here on my YouTube channel that you guys can actually see how much it costs to live in some of the most trafficked places or some of the most favorite places here in Southern California. So make sure that you guys go check out the videos at the end of this video, or that you guys just click right here. Now, I'm not going to go into in-depth about the utilities because they will vary. Like, for example, if you have a single-story home, a two-story home, if you have a pool in your home, if you have solar panels in your home, right? It depends on the location. It also depends if you live by the coast, if you live by the mountains, because it gets hotter in Menifee than what it gets in Oceanside. Some places in Oceanside are still in freaking the 1980s and they don't have ACs inside their homes. You got to have a plug-in AC. While it is a necessary thing to have an actual AC unit in Menifee because it gets hot as hell over there. Now, last but not least is your emergency fund. You want to ensure that you set yourself aside an emergency fund, specifically if you're a first-time homeowner, because you are about to go into uncharted, unknown territory for you right now, right? And the more that you budget and the more that you prepare yourself, you will be better off for unforeseen things that you did not include in your budget. So ensure that you set up at least a 30 to 90 day emergency fund whenever you buy your home. Now, this is not a must have, right? This is a nice to have. And as a matter of fact, what I always tell my clients is, I don't ask my clients, hey, listen, show me the proof of funds of how much money you have in your bank account, right? For me, how much money you have in your bank account is completely, it's not really important, right? What I really want to know is how much money you're willing to compromise through the transaction. What do I mean by that? For example, let's say you have $20,000 in your bank account and you tell me, well, I have 20, but I would like to use 10. That is a good budget to have because, again, I don't want you to be house poor and I don't want you to not budget for the unforeseen circumstances that might arise whenever you start moving in. Because remember, we can talk about the home inspection, which we're going to do a whole different video about that, but we can talk about the home inspections all we want. The home inspector might not catch everything until you start moving in there and start living inside of your home. So hopefully that helps you out. Some of the things that you should definitely develop for budgeting. If you want any more information or if you would like me to point you in the right direction, go ahead and go to the link down below in the description and I will 100% help you and guide you to prepare you to become a homeowner. And if you're ready right now and you have already done your budgeting, please go ahead and contact me down in the description below and I'll see you guys in the next video. Have a good one.